Pensions. Boring. If there's any instrument out there that so many of us don't understand, it is perhaps your pension. Because let's face it, it feels so complicated and there are so many types out there. And honestly, you couldn't be bothered because it feels so far away. And yet, when you check your pay slip, you notice that every month you are paying hundreds of pounds or dollars towards pensions. Add what your employer is contributing towards it, and it will hit even the thousands. This may actually be more than you are paying towards your savings account or even your investment account. And so, if there's an account out there where you are paying this much into it every month, then you might as well be interested in where this money is going to. What is it being used for? Are you on the best scheme or there's a better one out there for you? So, in this video, I'll be telling you all you need to know about pension schemes. I'll be using the NHS UK pension schemes as a case study, but the ideas shared would also be applicable to other pension schemes. So, stay tuned. Hello, and welcome to Diaspora Careers and Investments. For those of you who are new on this channel, my name is Shadrach, and on this channel, I speak all about personal finance, how to make money, multiply your money, and enjoy your money. And in today's video, I'm speaking about pensions. What is a pension? A pension simply refers to a pot of cash that you and your employer can pay into as a way of saving towards your retirement. This means that the money will not be accessible to you until you hit the normal retirement age, which is around 65, 66 years. But you can also access it earlier if you so wish to. Currently, the earliest you can access your pension money is 55 years. But from the year 2028, this will move to 57 years. The three main advantages of having a pension are: one, it is an investment for the future, so that when you are old and tired and weak and cannot work, you would have an income to maintain your standard of living, or else you may have to go to work or even work extra shifts even at an old age, or your standard of living may drop, and that is important to plan for your future. Secondly is the tax benefits. Usually, pensions are taken before you are taxed. And so it means that the amount of income that you are taxed on is lower than your actual, gross salary. So what some people actually do is that when they notice that they are getting a pay rise and to push them into the next tax bracket, what they do is that they actually increase their pension payments so that the amount remaining to tax is lower. And knowing that the money is going towards the future, they know they will get it back in the future. The third advantage of having a pension is that whatever you are paying towards your pension, your employer also has to make a contribution. Currently, you are to pay at least 5% of your income towards a pension, and the least amount your employer can pay is 3%. So you know that all things being equal, you are paying at least 8% towards a pension. So then, is it worth having a pension? I would say certainly so. I know some people who lived here, who worked here in the UK and retired back in Ghana. And because they pay their pensions here, now they receive their pensions even from Ghana. And once they convert the money into Ghana cedis or the local currency, it is a decent amount that allows them to live, a reasonable life. So wherever you are, whether you remain in the UK or, you travel overseas, you get, a decent amount to plan for the future. But also, if you don't enroll onto a pension scheme, it means that every month you would have more salary because your contributions are given back to you. But that money will be taxed, and so you lose the tax benefit. And also, your employer is not obligated. In fact, they will not give you their contributions, and so you lose that part also. So I would really think carefully and strongly encourage you to speak to a financial advisor if you are thinking of not having a pension, and I'll strongly advise against it. Since 2019, all employers are obligated to auto-enroll you into a pension scheme. So they are supposed to give you one. It is an auto-enroll scheme and rather an opt-out scheme. So you can choose to opt out by telling them, but they don't need to inform you before they enroll you into one. But I'll strongly encourage you to have one. How much should you contribute towards a pension? Well, that depends to a large extent on the type of pension that you are on. And that is absolutely crucial, and I'll explain in a bit. But currently, we know that the minimum you have to pay towards a pension is 8%, whereby you pay 5% and then your employer pays at least 3%. So that is the bare minimum. But there's really no limit as to the maximum you can put in. Well, technically there is, because there's an annual limit whereby if you pay more than that annual limit, you will pay taxes on the remaining. And that is currently 40,000. So if you earn 20,000 per annum, or 30,000 per annum, and if you wanted to put all of it into your pension, yes, you can do that, and you will not be taxed on any of that. In fact, you get a tax reliefs on those. But if your salary exceeds 40,000, or you want to put more than 40,000 into your pension account, then the remaining will be taxed, or you'll not get the tax benefit for the remaining. There's also a lifetime limit of currently around 1,073,000 or so, whereby your pension allowance cannot exceed that over the life course. So if your pension account ever exceeds that, you lose the tax benefits on the excess amount. So that is pretty reasonable. Pensions come in different forms and shapes and sizes and everything, but we can categorize them under two main groups. On one hand, we have the defined benefits, or the DB, or the final salary pension schemes. And on the other hand, we have the defined contributions, or DC, or the money purchase pension schemes. And this distinction is important. So let's tackle them one after the other. With the first type of pension schemes, the defined benefit, or the DB, or the final salary or care pension schemes, these are usually funded by the employers themselves, even though you, the employee, would have to make a contribution also. And with this kind of pension, you are guaranteed a percentage of your pre-retirement salary for life. So, whatever that percentage is, you get that as an annual salary for the rest of your life. And the NHS pension, teachers' pension, university lecturers' pension schemes, most of the pension schemes in the public sector are DB pension schemes. Let's take the NHS pension, for example. The amount you pay towards the pension scheme depends on how much you earn. So that if you earn from 0 to 15,000, you pay about 5%. If you earn from 15,000 to about 21,000, you pay 5.6%. So they are tiered. So the amount you pay depends on, how much you earn. If it goes over a particular amount, the amount you pay is higher, up to about 14%. So that is how much you pay towards that. And then your employer, which is the NHS, also pays about 20.6% in addition to that. So that is pretty generous. We see that based on the amount you are contributing and what your employer is also contributing, you'll be making very generous contributions towards your pension. But when it comes to the NHS pension, it's immaterial. It doesn't matter how much you are contributing, because what you actually receive as your pension income depends on a rate, what is known as the accrual rate, that is determined by your employer. Currently, it's 1/54. So what that means is that the actual amount you receive as pension will be 1/54 times your gross salary. So if you receive 30,000 per year, your pension income will be 1/54 times 30,000, and that's about 555 for the rest of your life. And that sounds quite disappointing, I know, but this rate increases over time. So in the first year that you work for the NHS, your pension income is 1/54 times your gross salary. You keep it down. In the second year too, it's 1/54 times your gross income, and then you keep that down. In the third year, 1/54 times that. But because your salary tends to increase, that amount will be increasing. And what they do is that at the end of the day, they sum, all that you've contributed. So essentially, 1/54 for year one plus 1/54 for year two plus 1/54 for year three. So essentially, if you work for the NHS for, say, 30 years, it becomes 30/54, because the denominator does not really change. It's the same. So it's just the sum of the numerators. So if you work for the organization for 30 years, it becomes 30/54 times your gross salary. I know this is quite simplistic, but that is an easy way to put it. And one would argue that, but if this money is being kept down, by the time I work for the NHS for 30 years, the first amount, that you put down would have lost value. So they also have what is known as a revaluation rate, which is essentially to adjust for inflation, so that the money that you kept down in the first year, which is 1/54 times your gross salary, does not lose value, but it increases with inflation. So simply put, if you work for the organization for 30 years, you get 30/54 times the gross salary, assuming it remained constant. If you work for 25 years, it's 25/54 times the gross salary. So So we clearly see that the amount you receive as the pension income when it comes to the defined benefit contributions actually depend on how long you worked for the organization rather than, the nominal value of how much you or your employer contributed. So is that good? Is that bad? I mean, I'll look at the advantages and disadvantages later, but that is really what the defined benefits is. I hope you're enjoying this video and you are learning something new. If so, can I please ask you to kindly subscribe to this channel, and while at it, like this video and leave a kind comment so that the YouTube algorithm will smile at us and we will reach more people. Mine is a very young channel. We are just under 1 year old. Kindly help me grow this channel. Let's continue. So when it comes to teachers' pensions or, university lecturers' pension, in fact, my pension is actually 1/85 times the gross salary. So if you're thinking 1/54 is quite small, then mine is even smaller. But of course, the formula is a bit different because in addition to the 1/86, they also give you a lump sum, which is 3 times that, but I'll not get into that calculation. But essentially, there are different formulas, but the principle remains the same. You receive a fraction, a proportion of your final salary for the rest of your life. The second type of pension schemes, the defined contributions or the DC or the money purchase schemes. These are more intuitive schemes in that the amount you contribute and your employer also contributes is given to a fund manager who then invests the money somewhere, say in the stock market or in bonds or in anything, with the hope that it will do well. Because pensions are paid over a long period of time, it is believed that by the end of 30 years, the fund would have done better. And so the amount you actually receive as your pension income depends on the performance of the fund. And so if it doesn't do well too, then it can affect how much you actually receive. So with this said, what do you think is a better scheme? Do you think the DB schemes or the DC schemes, which are better? The first advantage of the DB schemes, I think, is that there's a guaranteed income for life. So unlike the DC schemes where it depends on the performance of the fund, with the DB schemes, you don't have to bother about that because you have a guaranteed income for life. So whether the stock market did better or it did poorly, you couldn't care about that because you have a guaranteed income. But in the DC schemes, if the stock market doesn't do well or wherever the money is invested, if it doesn't do well, it can affect how much you earn. The other thing also is that with the DB schemes, you as an employee don't influence where the money is invested. In fact, you have no say at all. There is little, input from your end. But for the DC scheme, you get to sometimes dictate where the money is invested. You can tell them, invest it here or invest it there. They allow you to make an input. But you can also trust the fund managers to make the decisions for you. So is that a good thing or is that a bad thing? I mean, depending on how much control you want to have. The third advantage of the DB schemes is that even though you get a defined income or a guaranteed income for life, if you were to die earlier than your spouse, they would receive the income for the rest of their life at a reduced rate. So usually it is for 2 lives for you and your spouse. So that can be good. Another advantage is that in the DB schemes, even though you receive a guaranteed income for life, you can actually request for a lump sum. If you need, a huge sum of money to do something, you can request for a lump sum, and they would actually reduce your monthly, or your annual income to, adjust for how much you have received as a lump sum. So that can be a good thing. But when it comes to the DC scheme, with that amount of money in your pension pot, you get to decide how you withdraw the money. You can choose to withdraw all at the same time. There are some tax implications somewhere. Or you can choose to take it, every month. Or you can actually decide to buy an insurance, what is known as annuity. So you exchange the money in your pot for an annual income or for a monthly income for the rest of your life. So an insurance company can take the money in your pension pot and go like, okay, we'll take all the money and then we'll give you this amount for the rest of your life. The only disadvantage for that is that usually when you compare that scheme to a defined benefit scheme, the defined benefit scheme tends to pay higher than what an insurance company will pay you as annuity. There are also disadvantages with the DB schemes, as you would have seen already, in the sense that it offers very little flexibility. Unlike the DC schemes, if you wanted all the money today, you could literally withdraw everything and use as you please. But with the DB schemes, you can't, take all the money out. So that can be a restriction sometimes. Another thing is, with the DB scheme, if you and your spouse were to die, the money is, done. You can't, leave it to your children. But with the DC scheme, because it is a pot of money, you could actually will it to your children if you're unable to exhaust it. Of course, the disadvantage is that it is possible for you to run out of money before you die in the DC scheme, because it is a pot of money you are now accessing from age 55 or 65 or whatever. And so you can actually run out of money before you die. But in the DB scheme, you are guaranteed the income for life. So that can be an advantage or a disadvantage. The other disadvantage of the DB scheme really is the accrual rate, because it doesn't really depend on how much you contribute, but rather your salary. So that if it's 1/54 of your salary, then it is your gross salary that really determines how much you earn and how long you contribute into the scheme. But for the DC scheme, you can actually directly influence it. The more you pay into the scheme, the more is being invested, and so probably the higher the returns. So that can be an advantage or a disadvantage. So we see that in the DB scheme, it is really how long you contribute into the scheme that increases your accrual rate. But in the DC scheme, you could actually find a lump sum somewhere and invest it into your pension and be doing that. Remember, for the DB scheme, it is actually 1/54, in the case of the NHS, of course, 1/54 of your pensionable income. So your bank shifts, your extra shifts, and all of that, those are not pensionable. So it doesn't really influence it. So that can be, a disadvantage. The last disadvantage of the DB scheme is that it is really funded by the employer. We already see how much the NHS, for example, is paying towards the DB scheme, which is about 21%. So that is really funded by the employer. So that, touch wood, or God forbid, if the employer, goes bust, your pension would be heavily affected. This is unlike the case of the DC scheme, where the money is actually invested somewhere, usually by another fund manager. And so once the money is in the stock market, you know that you get access to your money. So with that said, what do you think is better? Is it the DB schemes or the DC schemes? In the world of pensions, the DB schemes are considered the gold standard, because if your income increases in the last years of your career, it means your contributions will also increase and you get more. And in fact, it is employer intense, because the employer continues to fund it. So there are those who have actually withdrawn from the DB schemes and just let you do the DC schemes. So if you have a DB scheme, then you want to think carefully about it before you lose it, because if you lose it, you're unlikely to get it back. The final question is, which of these two schemes should you invest in? Well, to a large extent, it depends on what is available. If you have a DB scheme at work, then that's what you go for. But you can actually have both. If you get a DB scheme from work, like you're a nurse, you're a lecturer, you're a teacher, you're a public servant, and you get a DB scheme, you can keep that, but also start your own DC scheme, what is known as a self-invested private pension, a SIP for short. In the sense that you can invest on Vanguard or Hargreaves Lansdown, or I'll put a link to it in the description box below. A lot of companies whereby you can actually invest in a pension, so that whatever you earn, you can choose to put a bit aside for your private pension. And that money is invested in the stock market for you for the long term. You still get the tax benefits in that whatever amount you put in there, the government adds 20% if you're a low taxpayer. But if you're on the higher band, you can claim the extra taxes and invest all of that. So you can actually have the best of both worlds. In fact, there are hybrid pension schemes like the University Superannuation Scheme, which is a hybrid scheme, whereby part of the money goes into a DB scheme and part of the money goes into a DC scheme. So you can also have the best of both worlds. So if you're a nurse and you work bank shifts, you can decide to pay pension on your bank at a rate you set for yourself. Well, I hope you found this video helpful. I know that it's been quite intense trying to understand different things, but that is the topic of pension for you. In my next video, I'll explain all you need to know about the self-invested personal pension, SIP for short. I'll show you which platform I use for my personal pension, how I claim the tax benefit, and how it's been helpful. If there's something you'd like to know more about, consider subscribing to this channel and like this video so that the YouTube algorithm can smile at us. And while at it, please leave a kind comment so that we're able to reach more people. Well, I hope this has been useful. I know I'll hope to see you in the next video. Stay blessed.